Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the money games corporations play. And boy, do we have a treat with TUCOWS' latest report. So in this report, TUCOWS is giving us the lowdown on their financial health for the period ending June 30th, 2025. We're going to dive into the numbers to see how their different businesses are doing and what it all means for their future. Looking at the big picture, TUCOWS has total assets of about $42 million. That's down a bit from the end of last year. On the other side of the ledger, their liabilities are around $500 million, and they actually have a stockholders deficit, meaning the company owes more than it owns on paper. Now let's talk about the nitty-gritty of how the company performed. For the 3 months ending June 30th, TUCOWS reported a net loss of about $15.6 million. That's a pretty significant chunk of red ink. And if we look at the 6-month period, that loss deepens to overall the company is spending more than it's earning right now. Let's break this down by their different business areas. The Ting segment, which focuses on internet services, actually saw revenue grow. For the 3 months ending June 30th, Ting brought in about $16.4 million, which is up from the same time last year. And for the 6-month period, they earned over 32,000 active subscribers now. But here's the catch. While revenue is up, Ting's costs are also rising, and not just in a normal way. A big reason for this is a one-time accounting adjustment related to their leases, which added about $3 million to their expenses in the second quarter. On top of that, increased mobile telephony costs, including penalties for not meeting minimum commitments with their mobile provider, are really hitting their bottom line. This led to a net loss of over $21 million for Ting in the second quarter. Alone Ackerman alocht hand in the second quarter alone. Now let's look at Wavelo, their platform services business. This area is doing quite well, with revenues increasing quite a bit. For the 3 months ending June, Wavelo brought in about $12.7 million, which is a solid 21% jump from last year. The 6-month revenue is over $24 million, also up by 21% jump from last year. The 6-month revenue is over $24 million, also up by 21% jump from last year. The 6-month revenue is over $24 million, also up by 21%. This growth comes from their existing customers like EchoStar and new ones signing up. It seems Wavelo is a growing part of TUCOWS' strategy. Moving on to TUCOWS domains, the wholesale domain services part of their business is also performing well. For the 3 months ending June, they earned over $51 million, a 6% increase from last year. This is mainly due to price increases from domain registries. The 6-month revenue here is over $101 million, up 5%, again driven by those registry price hikes. They also saw a nice jump in their value-added services like expiry auctions, with revenue up 29% for the quarter. Their retail domain services are also showing positive movement. Retail revenue for the quarter increased 11% to over $10 million. This is thanks to more sales of their portfolio name domains and an overall increase in retail name sales. In contrast to the growth in other areas, the corporate and other segment, which includes mobile services and intercompany eliminations, saw revenues decrease. This decline is linked to fewer transitional services provided to EchoStar and a slight rise in intercompany charges. The company is clearly shifting away from its smaller mobile customer base. When we look at the cost of revenues, things get a bit more complicated. Overall costs went up by about 11% for the quarter. A big part of this increase, as we saw with Ting, was that one-time lease accounting adjustment. But even without that, costs related to growing Ting's subscriber base and higher mobile penalty costs are also pushing expenses up. Interestingly, TUCOWS managed to cut down on their sales and marketing expenses. For the 3 months ending June, these costs dropped by 19%, mainly because of fewer personnel and reduced marketing efforts, especially at Ting. This also happened for the 6-month period, with a significant 31% decrease. This shows a focus on efficiency after some workforce reductions. Technical operations and development expenses also saw a slight decrease, down 4% for the quarter and 8% for the 6 months. This is also likely due to the cost-saving plans and workforce reductions. General and administrative expenses, however, saw a small increase of about 5% for the quarter, mostly due to high facility costs and professional services fees. For the 6-month period, these expenses were relatively flat, showing slight decreases in personnel costs. Now, let's talk about the other significant items. Other income expense net went from a positive $3.8 million in income for the quarter last year to a negative $10.5 million in expense this quarter. This swing is mainly due to higher net interest expenses, lower other income, and a drop in income from the assets sold to EchoStar. The interest expense increase is largely from the new term notes issued for Ting's fiber expansion. Adjusted EBITDA, which is a way to measure the company's operating performance before certain expenses, paints a more positive picture. For the 3 months ending June, adjusted EBITDA went up by 37% to $12.6 million. This improvement is driven by the strong performance in Ting, Wavelo, and TUCOWS domains, along with cost savings in marketing and personnel. The 6-month adjusted EBITDA also saw a massive jump of 96% to $26 million. Looking at liquidity, things are a bit tight, especially for the Ting segment. As of June 30th, Ting had about $35 million in unrestricted cash. However, their long-term liabilities are massive, with over $289 million owed on their term notes, and another $102 million related to preferred units. They also had an operating cash flow deficit for the quarter. The report explicitly states that Ting may not be able to meet its financial obligations over the next 12 months without additional financing. This is a potential red flag. This suggests that while the growth in Ting's internet subscriber base is good for revenue, the heavy investment required for network expansion is a serious strain on their finances. They are heavily reliant on their preferred units and term notes to keep things running, and if they can't secure more funding, it could seriously impact their operations. Overall, so what's the story here? TUCOWS is in a real transition. Their TUCOWS domains business and Wavelo platform services are doing well and showing growth. However, the Ting internet business, while expanding its subscriber base, is struggling with high costs and a significant need for financing. The company seems to be balancing growth in new areas with cost control in others, but the financial strain on Ting is the most pressing concern. They're essentially betting big on Ting's fiber expansion, and failure to secure the necessary funding could have serious consequences. The management acknowledges this risk quite directly in the report, which is at least a sign of awareness that the financial strain on Ting is the most pressing concern. They're essentially betting big on Ting's fiber expansion, and failure to secure the necessary funding could have serious consequences. The management acknowledges this risk quite directly in the report, which is at least a sign of awareness. Now, looking at these numbers more broadly, TUCOWS appears to be navigating a challenging market. The growth in Wavelo and domains looks solid, but the situation at Ting is concerning. They need to carefully manage their expansion and secure funding to avoid further financial strain. It's a high-stakes game of growth versus solvency. Alright, that's our breakdown of TUCO's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.